If you don't know how much money you're risking before you enter a trade, you should not be placing that trade yet. Because one of the most easiest ways beginners blow accounts is knowing exactly where their stop loss and take profit is, but having no idea what they actually equal in dollars. And the good news is this is way easier than people make it sound, and I'm going to make sure to make it very simple for you guys. So in this episode of Trading from Scratch, I'm going to show you how to calculate your risk on the S&P 500 and the Nasdaq, how ticks translate into dollar amounts, and how to figure out your total risk based on how much contracts you are trading. And don't worry, for you Forex traders and for you guys that trade other indexes, I'll be dropping a risk calculator later in this video, so stay tuned. By the end of this video, you should know exactly how much dollars you are risking when you place your stop loss and your take profit. Make sure to like, comment, and subscribe, and let's get straight into the charts. All right, guys, let's get straight to it. So there's literally three things we're just gonna pin down in this, video. Pause. What the fuck? Dude, I'm dead. But nah, let's get straight into it. So three things we're gonna go over in this video. How much one tick is worth, mini slash micros, you will understand in a second. How many ticks your position is, very easy. And how many contracts you're trading, also very fucking easy. Okay, let's get straight into it. All right, guys, so it's pretty much an easy formula. All right, so it's gonna be your tick value times your take profit slash stop loss distance times your contracts, and that equals your total risk. And it is different for minis and micros, but for now, let's just focus on minis, which as you can see is actually what I'm on right now. Mini futures. Micros are pretty much just going to say micro, and it's just a different sizing, but we're going to go over both of them right now because they're pretty common. And then we'll also go over the S&P 500 as well. All right, so on NQ, guys, one tick equals $5. So take your tool right here. If you don't know where this is at, go over here. You see your forecasting tools, star the long position and the short position. Let's click long position. Let's put it on the charts. Okay, so according to this math here, one tick equals $5. So if we have 60 ticks, how much money is that? That is $300. If we have the common known 100 ticks, that is $500. Why is that? Well, it's because we are looking at one tick to be $5. So we do 5 times 100. So that is why here on our formula, we have the tick value, right? The tick value is $5 times the stop distance. The stop distance in this case is 100. So 5 times 100 equals $500, right? And then the contract size, which is what we will get into next. So just showing a little bit more examples. If we have 200 as your distance, if I can land it on 200, just imagine that's 200. That is $1,000. Why? Because one tick equals $5. 5 times 200 is $1,000. I hope you guys paid attention to school because this is basic math. I suck at math, so if I can understand this, you can as well. And the stop loss and the take profit are always going to be under the same size and the same formula. So if we have a stop loss at 200 ticks, the ticks are this number you see right here where my cursor is, okay? 200 ticks would be $1,000. If we go down to 100 ticks, that would be $500. Okay. So now let's talk about contract sizes. All right. So remember, according to this, right, the total that we get with these two numbers right here, you times that by the contract. So very, very simple. So with this margin right here, we have, 100, tick stop loss, right? 100 tick stop loss. That equals 500 US dollars. Okay. And now what you're going to do is multiply that number. Let's put by C, which is the contracts. So now if you go over here, this is where your contracts are on trading view. Okay. You can change it to 1, 2, 3, 4, 5, 6, 7, all the way up to whatever you want. Most people usually do 1 to 3 contracts because you are increasing risk. You'll see what I mean in a second. Let me briefly show you where this is on Top Step as well. Yes, I believe these accounts. These are old accounts I haven't traded in a minute. But I'm on the practice mode, being able to show you guys on Top Step as well. You come over here on your active position list and you will hit this plus sign to go up to 2, 3, 4, 5. If you want to quick scale up to 1, 3, 5, 10, you can use these bubbles as well. Once again, though, you will be increasing risk. So do this at your own risk. But yeah, you multiply this number by the contract size. So let's say we did 2 contracts here on the same exact position of 100 ticks across our stop and take profit. That means you will multiply these two numbers basically by 2, guys. Pretty simple. That's a crazy 2, my fault. But yeah, multiply it by 2. What do you get? $1,000 that you're risking. But there is an important clarification that you guys need to pay attention to. This doesn't mean your margin has increased. This is why this is risky. You literally still have the same small stop loss of 100 ticks and the same small take profit of 100 ticks, but now the value has increased, the risk has increased, but also the profit has increased. And now in this small size of trade, you can now make upwards of $1,000. This is why people scale contracts rather than scaling size. But with the benefits of being able to win more on a smaller size trade, you can also lose more on a smaller size trade. So that is why it is a risk to do so. So I just want to clarify, the same thing goes for 3 contracts, 4 and 5. If you had 5 contracts, right, down to 5, yeah, same exact thing. You'll be multiplying this number by 5. You'll be multiplying this number by 5. And remember, guys, what is this number? This is your dollar amount. And what is the first number? That number is your ticks, okay? Once again, you can find the amount of ticks you are using on your trade right here by laying out the bracket. And you can see that number right here where it says 105 and 104. We were just rounding up to 100 for you guys. But let's get into the S&P 500 now, because it's pretty much the same formula, just a different tick value. All right, guys, so for the S&P 500, which by short, we like to call it the ES minis, 1 tick equals $12.50. So yes, very, very different from the Nasdaq. If we go over here on the S&P 500, you will see that 40 ticks is actually basically the same exact value as 100 ticks, because 40 times 1250 equals $500. And that is the same exact amount that you would be able to make with just 100 ticks on the Nasdaq. So let's look at what 40 ticks looks like. Now you guys see, look how much bigger that is. 40 ticks on the S&P 500 is equivalent to 100 ticks for your stop and take profit on the Nasdaq. So if you like to have a little bit of more room to work with, the S&P 500 may be for you. But this video is not talking about the best index for you. It's just talking about sizing. But just wanted to show you guys visually how it looks different. All right, so very simple math. If you have 40 ticks across each one, let's map it out. 40 ticks equals, okay, 40 ticks across your stop and take profit equals $500 USD. Right? Very, very simple, guys. And then what do? We take that number and we multiply it by contract size. If you have 1 contract, this stays the same exact value. If you have 2 contracts or any other number, you multiply it by the amount of contracts. And in this case, you would get $1,000 on a simple 40 tick trade. Okay. Very, very simple. All right, y'all. I don't know where that accent came from, but yeah, pretty simple math for you guys. Now I'm just going to make it a quick, brief 2 last things. I'm going to give you guys the calculator you can use if you trade different indexes and not the Nasdaq or the S&P 500, which I don't know why you would. In my opinion, I think these are the best indexes. And if you just trade Forex and don't trade futures to begin with, yeah. So I'm going to give you guys a calculator for that. And I'm also going to quickly show you guys the calculations. I'm not going to go through it like this, but I'm going to show you guys the calculations for micros because they are different from minis. And I'll tell you guys briefly the benefits to trading micros. All right, guys, briefly going to show you guys this. So 1 tick on the micro S&P 500 is going to be $1.25. 1 tick on the micro Nasdaq is going to be $0.50. So yes, you guys see very, very different from using minis. Now, if you guys are like, what in the world? Why would I trade micros? I mean, I thought the same thing trading, but you know, once I actually got into it, I understood that some people, they want, you know, larger stop losses. So maybe you want your stop loss to be 100 points. Maybe you're better off trading micros because you actually have more room to work with. But on the downside, you know, you're also going to have really longer trades because your stop loss now is going to be worth less as well. Always remember, your stop loss and take profit are under the same formula according to, you know, whatever you're on, whether it's micros, minis, according to how much ticks, and according to how much contracts you are using. Yes, can you have a take profit and stop loss with different ticks? Yeah, but you are still under the amount of contracts according to this number right here, whether you're on micros or minis. And yes, the same exact thing, always make sure to times this number by the amount of contracts, whether you have 2 contracts, whether you have 4, or whether you have 7 contracts, or even 15 contracts. People tend to use more contracts on micros because it is a smaller value. So it makes sense. But just always remember, once you look at your distance of your ticks and you multiply that by how much your value is, make sure to times that by the amount of contracts you are using. And that is pretty much the same formula for micros and minis. It's the same exact thing. All right, so I'm keeping my promise for those of you who are on Forex or just trading under indexes. You basically search up baby pips calculator and you can use this as a position size calculator. Yeah, it can calculate the amount of pips, which is basically like points / ticks. It's all kind of like interchangeable, but it's a little different for Forex and stuff like that. So yeah, you will use this, and it's pretty well known and it's pretty trustworthy, so you can use that or just chat GPT it, bro. But for my Nasdaq people, my S&P people, you feel me, it's pretty much the video. I hope you guys enjoyed, and if you have any questions, put it down in the comments below. All right, yeah, that's pretty much it. So calculating risk does not need to be complicated. All you need to know is your tick value and your contract size. That's literally it. And if there's one thing I want you to take from this video, is never enter a trade without knowing how much you are risking. That number should already be known before you even click that button, because risk management isn't something that you figure out mid-trade, but it's something that should start before the trade even exists. If this video helped you guys, make sure to like, comment, subscribe. Check the description where I have a link to my Discord as well as my Instagram. I'll catch you guys in the next one.